Welcome back, everyone, to another episode of Profiles in Risk. I am your host, Nick Lamparelli. It is the dog days of summer, and today we're going to be talking about captives. And I have my captive friend, Aaron Gordon. Aaron is the vice president of Gordon Companies, and we're going to be spending this entire episode talking about him and captives and all the good stuff that you can do with it. So, Aaron, you keeping cool?
I'm trying. The AC's pumping here. Been a little warm.
Must be like 100 degrees in New York City.
It was a little humid over the weekend, but nothing good AC. I say the greatest invention in the last 300 years. AC.
Jeez.
Challenge me, and I'll tell you why.
I'm not going to challenge you. No, people die in France from heat waves. It's because they don't have air conditioning. It's not a thing. But that's a thing for us.
It's not for people like me. My wife knows that in our house you can wear a sweatshirt. That's fine, but I don't sweat in my own house. So
yes,
figure it
exactly. I agree 100%. Aaron, we're going to be talking about captives. Before we jump into that particular topic, why don't I kick it over to you? Give you a couple minutes to give you your elevator pitch. Who is Aaron Gordon? What do you do?
I am. Well, first of all, thanks for having me here. I am a second-generation trusted advisor. It's the hashtag that I use most. I have the great privilege of what probably best describes me is I have the great privilege of sitting with my mother's office to my right and my father's office directly to my left, which leads to a lot of very special times. And what it does mean is that my day-to-day trusted advisory risk management business is what some would call old school, some would call boutique, but I just say it's about the service. And everyone says, don't pitch on that. Everyone provides great service. I like to say that we provide old school risk management. So I don't just sell products. One of the things I'm looking forward to discussing is the whole, idea of captives, and it's become a hot topic again. But the way that my family got into that business was traditional insurance products weren't fitting the need of a client of ours 35 years ago. Obviously, I wasn't around, but of my father's. And what is the best option for the client? It ends up being a good option for the manager, the advisor as well. But it's how can I best serve the client? Sometimes that means that we recommend a product that we may not be able to sell directly or assist with 100%. But we try to focus on that to be able to kind of round things out. And I think that that's, a good segue to what we hope to accomplish today.
Yeah. So I'm a big fan of captives. I've, being in the Nat Cat space, I've thought very long and hard about situations where we struggle to get capacity for a particular client. And, I'll whisper to the broker, hey, have you guys considered a captive? I mean, if you're struggling that hard, and I'm just surprised it hasn't taken off. So just for the sake of the audience, let's scratch beneath the surface. Let's talk about for those that don't know that are listening, what is a captive?
A captive is a way in its very basic form for the insured or the consumer to take on some of the risk themselves, take some responsibility for that risk, or the captive to take on some of that risk, and thereby not only be able to control some of their expenses, but ultimately control some of their insurance destiny. Yeah. Now, that's the 10-second version. It's interesting that you say that there's a lot of people that, that it hasn't taken off, or why hasn't it taken off more? And I think that gets to the root of really what a captive is and what risk management really ought to be, or what it used to be, or what we hope it will continue to be. And that is, it's a tool. And so many people look at what we do on a daily basis in the risk advisory space as an annoyance, an expense, a liability, necessary evil, however you want to look at it, which are all true from varying consumers. But once you get past the fact that you're going to be purchasing a lot of insurance if you're a successful individual or company, if a person cares about it enough or is interested in it enough, there are opportunities to take a hold of your risk. And if you can do that, it's one of the only expenses out there where you can say, oh, this is a quote unquote necessary evil, but I'm going to control it, or I'm going to try to do it the way that I want, or I want to be involved in the conversation, which is where most of our captive businesses come from, are those who just say, hey, like, this stinks and I want to change it, or I want to, swim against the tide. And it's pretty amazing. I mean, there's a lot of like really cool stuff about it. You end up with like competitors working together,
Yeah.
which
So
is
to be clear, controlling your risk, this goes well beyond like raising your retention or your deductible. This is, in its purest sense, the captive means that the policyholder, the property owner or whatever, the one that has the exposure, gets to actually own captive part of the exposure. They can create a separate entity which they may partially own or fully own, and they actually play insurance company.
100%. And that's and when it's good that you pointed that out, because it's not just the spreading of the risk or the limiting of risk, but it gets down to each nitty gritty piece. One of the or two of my favorite parts of that, which we can get into in more detail. One is, yes, you may start by owning it all yourself, as you said, but you can invite others to join you, but you own it. And as long as you, and that first step, unlike a traditional insurance company where they have a certain quota or a certain model or a certain numbers that they have to meet, so they may take different types of risks, you can take what some people will say are worse risks, because the fellow physician, or the fellow contractor, and therefore
Manufacturer.
and therefore you can say, hey, these are the people who will buy into my risk management profile. But you could also say, hey, some people think that this is the best client in the world, but I don't want to partner with them in this endeavor because they might not be involved. One of the other things that I love about it is really the claim control, which nobody likes to talk about because nobody likes to talk about claims. But if you own it and you're, quote unquote, as you said, great term, playing insurance company, that means that we might be getting into the nitty gritty, but that means that
Get into the nitty gritty. Let's get
that
into it.
a consent to settle, which everyone says is in every insurance policy and all that, and some have it, some don't, and for some people it's a selling point, and for some people it's not. If you own a piece of this, and every single day you're speaking to, whether it's your reinsurer, whether it's your excess insurer, yeah, they may have a bigger stake in each claim or in ultimately the policy aggregate, but you as the individual, and you as the individual consumer, if you're a physician, you as that individual physician, because you're a partner with the company, have a lot more say. So
Yeah.
Just because I'm stuck on the consent to settle thing, just for this minute, if you think about it, consent to settle is great, and I don't have to settle if I don't want to, or I can tell my carrier that I like to settle, and then they are supposed to settle for me. Let's say you disagree. The average consumer doesn't disagree because they say, who am I? I'm a small consumer. I'm a little fish in this huge pond, and there's a multi-billion-dollar insurance company behind me. I'm really going to take them on. And so people often don't have that inner desire to help themselves in this conversation. But when you're a part of it, and when you're at the meetings, when you're involved in the claims as the consumer, as the insured, then of course you think about it differently. You're on the board, you're sitting in the room, you're not just paying a premium and then saying, hey, I'll call someone if there's a problem.
And that's the biggest part of it to me is, let's say you are successful as an individual, as a family, as a corporation. It is very likely, in my experience, that you will not be able to find you are a square peg and insurance is a round hole. You can force it, but it's likely that you're going to have some sort of exposure because you're successful, because you're risk averse, that insurance is either not going to cover, you're not going to be able to find inexpensively. They're going to rate you as if you're a riskier exposure than you really are. The captive gives you not only the ownership of that piece of it, but it gives you the incentive
100%. And
to
also,
reduce risk.
it also just gives you the incentive to care. I know that sounds terrible, but again, if you just look at it as an expense item, and yes, there are some things, there's people who are commoditizing every part of this business and every part of this industry. And it's for a different time. But there are certain products that probably should be commoditized, but there are also certain products and certain consumers who say that they don't want to be commoditized, and they get so frustrated with this situation. They say, I've been spending tens of thousands, millions of dollars year over year, and I never have a claim. Now, those people probably do have a claim that they just don't mention, but I'm a great risk and I'm not seeing the benefits of it. Or the flip side is also true. I know that the business that I'm in, I know that my history or the way that things were managed in the past, I'm not the ideal insurance risk, but I firmly believe that I can be a better risk. And either way, I can't get the ratings that I want because a computer can only go so far. The more you lose the human element, the peg is getting more circular and more circular, and the hole is getting more square and more square, if that's, to
Yeah.
borrow your term. Whereas here you can customize every piece of it, assuming again that you have the fortitude to be able to do it. But you can customize anything. You can be a part of every claim. You can be a part of only some claims and then give up the totality of claims after a certain number. You can do a quota share where you can have, a percentage of every claim. You can have a finite number of every claim. You can totally limit your risk, or you can say, hey, we're in this in 100% in partnership. So,
You can fill in the gaps.
it's amazing. It's really
Right?
amazing.
Like, let's take your two examples. One, you're a great risk, right? That example where your company spends $1 million a year on insurance. Let's just assume they never have a claim. Let's just kind of say that. So $1 million a year is going out the window, and that $1 million is basically some sort of contractual agreement, since they are a good risk, for some future catastrophe that is.
Or for somebody else now.
Yeah.
You're paying the money and someone else is using it. The bad risk is using it.
So if you're that confident that you're a good risk, why not take that $1 million, route it through an entity of your ownership, and put your money where your mouth is?
Part of it, 100%. And that's,
Yep.
that's actually how the captive that we were involved in for 30 plus years and we're still involved in got started, because it was a very wise and sage emergency physician who was an amazing man who we unfortunately lost 6 years ago. But he said, hey, listen, I know that emergency medicine, right when it was, starting, it used to not even be a specialty. It's hard for us to think of it that way, but it was just, everybody stepped into the emergency
Mm-hmm.
department. There was no board certification in emergency medicine. And he said, I know that, people don't know how to rate us. And I feel like that whenever there's a complaint, it just goes into this big funnel with every other specialty. And I want to be involved. And it turned out that over the years, they put millions of dollars away in the bank to be able to limit their spend over time, when everyone said that they were crazy, because they said, even if we're a fair risk, so even if that person that first year actually has the first claim, it's on their terms and they actually have the potential to at least save, right? Whereas once you write that premium check in the traditional sense, it's over. It's out of your
Yeah.
control. You're not going to bother. You could get audited and end up having to spend more, even if you didn't have a claim, which
Yep.
as the agent, the traditional agent in Aaron Gordon says, that's the most difficult conversation that I have every day, is someone who paid the premium, didn't have a claim, then gets an audit and has to pay more. I didn't even use it.
Yeah. So that's case number one, right? Where you're an awesome risk. There's a misunderstanding in the market. You're not being rated correctly. And rather than have all of this money go out the window, you get more control over it. And if you keep being an awesome claim, you have an entity now that is generating surplus for you and is increasing the value of your company. So that's.
And by the way, you could also get free insurance 1 year. You get enough surplus, covers your financials. This year, we're not writing any checks for insurance.
There you
Forget
go.
about the taxes that have to do with that, but it's an amazing thing. Oh, it's free.
Yep. Yep. So now you brought up use case number two, which is you're not or historically you have not been a good risk, but maybe you have new management or someone that's coming in saying, hey, we're not going to be able to afford this insurance. This expense is going to be such a nut for us that we need to culturally change who we are from a risk management standpoint, and we need to put our money where our mouth is, and we need to turn this around So we need to retain some of this risk. So it's not a gigantic expense for us, and really clamp down on the risk management and prove that we can be a good risk. Correct?
Correct. The thing I always like to think about, and I don't, it's either UPS or FedEx, but one of the big shippers, and I love to watch it in New York. My father and I are almost obsessed when we see a truck. They have two rules. I don't. It's one of them. I apologize for not knowing exactly which one, but one of them has two rules: no left turns, and you never go in reverse. So I like to think about that because reverse, they were hitting people. Left turns are more dangerous than right turns. So they'd rather you waste the time and make 3 right turns to make a left turn. So the reason why I like to use that example when it comes to the captive bad apple, if you will, is the guy who came up with that, or the person who came up with that, the year they implement it, odds are their experience went down by who knows how much percent. But they couldn't monetize that. They couldn't monetize the fact that they figured out that, hey, our risks are, our claims are coming from these two things, going in reverse and turning left. And if we stop doing that, we'll be able to increase our profitability for insurance. But every insurance company is going to say, what do you mean you've been running a 300 loss ratio for the last 10 years? In fact, we're non-renewing you, we're out of insurance companies. So we're willing to take it, and it's not something that, and I apologize if there are any actuaries listening to this, but it's not something that an actuary can figure out. Like captives are like, we work with actuaries and you need an actuary and all those things, but the standard actuary, some of the things that you try to do, they just don't get. It's outside of
Well,
the traditional modeling.
yeah, well, that's it, right? So you need data, and some of the things you try to do with a captive may never have been done before. So there is no data. So someone has to sort of figure out, we need a crude model. We need something that can project a loss estimate on this so we can know roughly how much premium we need to send our own little captive in order to fund this thing. Which gets into like where I think it's just so interesting because, correct me if I'm wrong, if I understand this correctly. Once you have a captive, it's not like you have a workers' comp captive and then an auto captive and a property captive. You can theoretically set up one captive and put all different exposures into it as long as it meets the standards for like an insurance company and whatever IRS standards are put in there. Am I correct in understanding
100%.
that?
So there's IRS. I hear you. You are very important, but there is also, as long as the regulators buy in, right? Insurance is still a very heavily regulated industry, even on the captive side. So I don't want people to get the impression that A, it's easy, or B, they're all successful. But when you have the success, or when you think about the two captive capitals of the United States, let's say Vermont and Delaware, we're big Delaware people, so we'll just use that. When you develop that relationship from a regulation standpoint and from a risk management standpoint, and you develop that reputation, who wouldn't want to do business with you? And then you can expand that model and say, hey, I thought that this was just going to be for, as you said, workers' comp, but now I can use those financial advantages. I can use that insurance experience that I've had that I didn't have 5 years ago as a consumer, and I can say, hey, why can't I tack this on? Why can't I tack that on? What my father likes to say is that it just gets tricky because you don't want to lose that core competency. You don't want to lose sight of what got you here and all of a sudden say, okay, we're just going to take all of our insurance, we're going to find everyone we can, and we're going to become the big bad insurer, because then it could, as many have, go in the
Yeah.
other direction.
So I need to unpack a couple things there. One, you can't just set up a captive.
Yeah,
It's still a licensed insurance company. It just happens to be owned by, let's just say, a single corporation, but it can get more complex than that. So you still have to go through the process, the state process of getting the state to kind of bless it,
yeah, and it's
right?
not, and it's like dealing with any state regulatory agency. So it's not,
So
doesn't happen overnight.
how does it work when? What are some of the factors that a state regulator would look at? Let's say, let's take cyber, where there is an insurance market, but I don't think the insurance companies are actually providing capacity for the entire swath of your cyber exposure. So there could be pockets where, hey, I'm not actually covered for this element of cyber if it occurs. If I have a breach, my insurance companies aren't going to cover me. What does it take to carve that piece out and say, I'm going to create a captive out of this, or take this and put it into my existing captives? What do the regulators want to see around that sort of risk management?
So the foundation are financials and business plan, right? That's the first thing, because what a regulator doesn't want is in their state or their domicile to have a bunch of captives that go bankrupt. It's not a good thing for the regulator. It's not a good thing for ratings. It's not a good thing for, if you will, marketing to bring further business into the state. So there has to be some sort of financial stability. Now, with any business, obviously there's risks, but there has to be the sound financials have to be there. And then it's more about business plan and less about actuarial data. Yes, you need, I don't want to, I don't want to, uh, point anyone in the wrong direction or give any false hope that this is easy, but obviously you need legal, you need a business plan, you need accountants who verify the financials, and you need an actuarial study. That for sure you need. But that actuarial study is different than a traditional insurance company's actuarial study, because it's saying, what are your kind of limited risk, what are we trying to cover exactly in this little box, or in this large box, but in this box, and how is this entity going to risk manage that? So when you look at the business plan, whereas the traditional model is numbers, 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 it's also like, hey, we are a captive that wants to specialize in medical billing companies. And we want to take the cyber risk along with the GL. So we're going to take the GL and the cyber, because most of the risk on the GL side for a billing company is probably linked to the data. So we're going to take the cyber, and here's what we're going to do different than everybody else, which is why we're going to take a bite of this apple where nobody else would. And you can gain that flexibility, not so much with picking out like individual pockets of holes in policies, but saying, here's what I can do better than that policy to more specifically meet my need.
Yeah.
I'm not sure I would recommend pulling out and saying, here's a gap that I see in the policy, so I'm just going to insure that gap. But here's the gap that I see in the policy. So instead of me paying an insurance company for 90% coverage, when what keeps me up at night, I'm buying this, but last night I was kept up because there's something that's not covered. I'm going to say, you think that you insurance company or lawyer think that my risk is here. I agree that that's part of it, but my risk is really somewhere over here, and I'm going to cover them both.
Okay.
And I'm going to control that.
Yeah. So off the top of your head, what are some of the zaniest type of captives that you've seen? What are some of the types of exposures that you've seen covered in a captive that I think, let's say there's a business owner, a risk manager here, where they would be like, oh, that's interesting.
It's a great example, and it is the millennial me talking, but if you think about like Uber or like those rideshare type places, I had someone call me and they said that they wanted to start a company that was going to do hourly tours. And in New York, by the time you get done with TLC, and is it TLC, is it not TLC, what kind of auto insurance do you need, assigned risk, but it gets expensive, and nobody understands, because nobody knows that this car is only going to go, this is actually a great example, nobody knows that this vehicle, there's in the manual, it said that they can only go 20 miles an hour. That's a huge risk management tool. In the middle of Manhattan, rather than going back and forth through lanes, we're going to stick to 15, 20 miles an hour. That takes our severity and drops it, and for sure drops our frequency. So if you just think about how like home healthcare, ride sharing, Airbnb is a great example. All those kind of if you think about like the first traditional underwriter that someone came to them and pitched them Uber or pitched them WeWork, and said, here's this thing that it's not really an office for one company, but it's not really an office for many companies, and we're not sure how many people are going to be in a given day, and do you want to rate it on square footage, and we're going to do our own risk management, and we're going to background check the people, and then people were overindulging on alcohol, so there was a big uproar because they started capping how much alcohol you can have or the time you can have alcohol. And to me, as an insurance nerd, or geek, it's my brain just says, oh, like some risk manager or some risk person thought of that. And that's what makes it exciting. And that's why I think that there's going to be a lot more of it. Because I mean, think about it. When you drive an Uber vehicle, everyone knows what Uber is, right? Even where you are, right? Everyone knows what Uber is. So when you're driving for Uber, the driver is covered by Uber only when they have a passenger in the car. Think about that for a minute. How, if you're just a traditional actuary, how do you actually analyze that? You can't.
You don't. You don't.
You
You
know,
can't.
but if you're the captive or the person, the risk manager in that company that has the bag, you say, well, here are the drivers. Here's the risk that we think we're going to have. We might rate it based on number of pickups, not so much the mileage that they're driving, but oftentimes those smaller rides are more risky than longer, less frequent rides. And so those are kind of, that to me is really cool. We have a lot of experience in the malpractice space, so I really like that, because when you want to talk about cool claims, I know it sounds kind of morbid, but the medical field is just amazing, and it's just ripe for these kind of things. Ambulatory surgery centers, who thought that to quantify the risk just as outpatient? Like, hey, the place has to be empty at 6 p.m. That means that there's a certain amount of risk that we just can't take. So that orthopedic surgeon, they're doing only the lowest 10% risk surgeries. No actuary in the world had a plan for that.
Mm-hmm.
Nobody. So, I mean, the workers' comp, we were involved with, trying to, it's very prevalent now with the opioid crisis, unfortunately, but we were involved with a group of physicians that said, hey, we want to work with insurance companies to limit their risk because we're just going to change the medication protocols. And that's going to cut multiples of billions of reserves. So when you talk about what's cool, I don't know, maybe I sound weird, but that's the stuff that I think is cool.
Yeah, and you should don't hesitate to be an insurance nerd. I'm looking for my pen around here somewhere.
I have the books.
Don't be an insurance geek. Be an insurance nerd.
I have them. Hold on. Let me grab right on my desk. You always talk about books. I got them right here.
Now I'm out of focus.
I got them all. So
there you go. Let's talk about ROI. You're pitching this to someone. How do you frame the ROI expectations?
It's all about expense control. It's really the people that are most fit for the non-traditional risk model or the captive model are those that things are just spiraling in a way that they don't like or they don't understand, and they can control those expenses better than they feel the insurance company can or will, because they know their risk model. So I tell people, you probably won't see a return in the first 2 to 3 years, but in the first 5 you could see huge returns. And that's just limiting expenses. Dividends are hard to come by just because of regulators. So it's very rare that you actually see just cash pouring out of captives to the insureds. It's not that it doesn't happen, but what you see is, and the big driver are premium credits. Like I said before, imagine if you have so much surplus or enough surplus that your required capital contribution is covered by your surplus. So if your business had a bad year and you don't want to use the advantages of expensing your premium, but you're trying to figure out how to cut costs, and you could just take this huge clump of expense and make it zero for this year.
Yeah. So just to clarify for those that are listening or watching, you go several years, you're paying premium into this captive insurance company that you own. It's someone has to invest the money. It's generating a surplus. That surplus could get big enough. That's part of the pricing formula for insurance, is how much money am I getting from the surplus. Theoretically, you could get to the point where the surplus is big enough where you don't actually have to put in any premium dollars. The
100%.
Big enough to actually cover your risk now.
Cover your risk now, and then a year from now, if it's still that's great. If you had a difficult claim year, so now you got to put some more in.
Yeah.
And the thing about it, as we mentioned before, is that you can make that decision. The individual captive manager, owner, the group of owners or insureds can make that decision and say, hey, this was a tough year because of X for us business-wise. We want to maximize the savings, or we all had a great year. We don't know what next year is going to bring. We actually want to pump this thing even more than we normally would, because we were able to pay our other expenses. And next year, there's changes in regulation. There's changes in other things coming. We're not sure. We had it with our healthcare clients. It was like, what are the reimbursements going to look like with Obamacare? What happens if our income goes down? Nobody really knew. Forget about the people who were against it. I'm not saying for or against. Nobody knew for a while what was going to happen. So if we can bank this money, if you will, and say, we know where we are now, we have the surplus, we want to contribute the additional surplus this year. Obviously, that's a business expense, so there's tax advantages there, which I'm not an accountant, so we won't get into. But you can then say you can hedge against the future.
Yeah,
which is amazing to me.
Whole point of it, right? So let's say there's a company that you've sold the pitch. We shake hands. Let's go. Let's do this. Let's talk about the life cycle. How long till you get, like, what's due? What has to be up and running? How fast can we get this thing going? What's the initial initiation cycle look like?
So I would say that the cycle is probably 6 to 12 months, just because we like to set realistic expectations. It could go a little quicker. It obviously depends on regulators. It depends on, I hate to say it, but consumer responsiveness, which is always an interesting one to get past. And then it's putting together a business plan, hiring an attorney to kind of handle that, deal with the hiring an actuary, getting an actuarial study, accountants to put together the finances, then pitching it to the regulators. Usually there's some back and forth on TPA. I left out intentionally the captive manager, who I think is the most important piece, because that's what we do. But the captive manager kind of puts those pieces together and make sure that the actuary and the attorney are speaking together. Because it's so heavily regulated, every T has to be crossed and every I has to be dotted. And it's not that it's insurmountable, but it's like, hey, if this addendum comes before that one, it'll just get thrown out of the funnel, and now you're 3 months behind because the regulator that you were working on is working on the next one. There's also, when you get into it, there's also the audits that happen, depending upon the state, annually, every 3 years, every 5 years. So those obviously are handled by the captive manager, but it's kind of traditional once it's formed, in that you work with a third-party claims administrator. That's another hat that I wear. That is probably, as I said, the coolest part of my job. I do love selling insurance, but I also, being involved in claims and getting to speak to attorneys and going to depositions and trials and things like that to me is cool as a millennial, because you get to see how these things work. And then there's as much involvement from the insured side as they want, which is I find a lot of people like it, because, like, hey, just so you know, this is what happened in this claim. And sometimes they're pleasantly surprised, and sometimes they're angry, and they say, no, I want you to go in this direction. We can at least have a conversation about it. Whereas in the traditional model, it's kind of just like, oh, we'll pay your claim, we'll kind of keep you updated, we'll tell you when to show up, and then we'll kind of go from there. So
we don't have to scare anyone. Basically,
right.
All of this stuff can be outsourced, including starting with going to Gordon companies and having them manage all the entire process.
100%. And it definitely can be managed, and it is managed. Obviously, there has to be some involvement, because you want to make sure that you're setting it up the right way, because you want to make sure that you fit what that individual client or captive needs. And I think that's really what's exciting, is that the principals or their risk management team, or we've had clients that have brought in risk managers for the sole purpose of starting something. And like, it was someone who was working in a different department, or was someone who was working at one of their competitors or at one of their vendors, even like their lawyer, and brought an attorney and said, hey, listen, you know our business, you know what can go wrong better than we can. Find the holes, figure out how we got to plug them, and then form the policy. Whereas if you call me as the Aaron Gordon, the insurance agent, I'll say, okay, great, buy this policy for this, buy that policy for that, buy this policy for this, buy this policy for that. Here's your whole picture, and the holes will be filled up naturally. Whereas here it's, hey, we can cover you from the moment you wake up in the morning till the moment you get to sleep at night, and you can be a part of that.
So what if the parent company is bought or sold or fails? What are the captive implications of that?
It is an insurance company, so there is definitely. I was talking to my father about this the other day. That I look at it as a pro and a con. So one is the savvy business owner can form a captive and turn it into an asset. And I'm not just talking about the cash that's in the surplus. Forget about that. That's an easy cash in the bank. But it is so many businesses see this as a mountain that they just can't climb. And so a lot of competitors say, hey, I want to acquire your business just to get your captive. So it
Really?
becomes, of course, because you have the paper, you went through the regulatory filings, you have this done. You have the solution, we have the problem, and we have the money. We're just tired of it. And some people are just lazy, and they say, hey, you're doing this right, but we're much bigger than you, and we'll just buy you for that. So that's one. The flip side is that it tends to be a longer term liability than a traditional insurance policy because someone has to manage the runoff of the captive. And yes, the greatest actuaries in the world can give you a pretty good view of where you are, but if you do have that catastrophic occurrence, or in the case of where you pick up, a portion of every claim, that catastrophic domino effect, there's a ton of claims. In the traditional insurance model, you say to the person who's acquiring you, or if you're going under, to the bankrupting, agency, hey, here's my insurance policy, I'm covered, go from here. Whereas in the captive model, you haven't finished paying until all the claims are paid. So it can be a liability of sorts because it's less quantifiable at any given moment what the tail is of that exposure. And we've had people who have just bought from their reinsurer, from their excess insurer, said, hey, we're going out of business. What will it cost for you to just take over first dollar and convert from the captive to the traditional model? And then they just pay out their surplus into the traditional model and convert.
Okay, that was my next question. Is there an opportunity? Is there such a thing as like reinsurance runoff or runoff reinsurance?
Sure.
Where the captive can just kind of die a slow death, but there's always a reinsurance stop behind it just in case something happens. But kind of like putting the sarcophagus over the Chernobyl
yeah,
power
100%.
plant.
That's good. So there is, I don't want to say 100%, but the vast majority has some sort of reinsurance piece of it, or excess insurer, or front, wherever you want to look at it, or paper behind it. So that obviously helps things. But at the end, when you're in the runoff stage, there could be a claim that's open that takes 5 years to hash out. So yes, you can either have an agreement in place where it's kind of like buying a tail, where you can just tail that off and push that to an insurer, or what some people do, is they'll sell the company, or they'll close down the company, and then they'll just keep a pocket of their highest risk cash on the side. Say, hey, this is what we need to run off the company for 3 years worth of expenses. If it takes less money or less time, we'll pay that to the acquirer, or just take that as a less dividend to us, and then just say, and we'll watch it. So,
Okay,
that's
fair enough. Tax benefits. We hinted at them. Generally, when I see either marketing or advertising for captives, that's one of the biggest things that they tout. Can you talk about the tax benefits?
So yes and no. There's a lot of advertising. There's a lot of noise out there about captives that are just for tax purposes, or what some may call tax shells or shelters. I'm not going to talk about that because I'm not a fan of starting captives just for that reason. But the most obvious tax benefit, and one that anyone would say is there, is when you control your expense, you can have a little more say in your taxes. So the costs of forming a captive are not personal expenses, they're business expenses. The ongoing operating expenses of running a captive are expenses, and therefore there are tax pieces there that, just in the example that we gave before, when you're investing in the captive to build up the surplus, that's not taxable because it's actual expense. You actually get a bill from the captive for that money, and you have to pay it. And then you have the surplus, and then you can use that to to further your business or to lower your expenses without having to take it as a taxable piece of income.
Yeah. So you get to control the risk management, you get to control the claims, you get to control the surplus. And instead of a retention where you're just retaining the risk, because you could do that if you just don't buy insurance,
Right.
right? You get to siphon off that premium to the captive, and that's a premium expense
100%.
that would go on your tax form with more
100%.
control.
Exactly. It's not just like going into a black hole somewhere at some,
Yep.
company in whatever state.
Yep. How can people learn more about captives? What are there any good materials, books, sources?
They call me. That's one. You can reach out to
Okay,
me. That's option number
fair
one.
enough.
The other is the best thing is to get in touch with people who are involved in captives. It's a lot of the material is just like really boring. It's just a lot of nitty gritty. A person who wants to learn more about a captive should learn more about their risk. And I think that that's, kind of the best way is before someone thinks about forming something or going down the road of all of the expenses or the items, a person should look in the mirror and say, what am I doing? Where are my pain points on the risk? And then dig into that. You can learn, I mean, there's good books on the basics of captives. There's books on the, what was going on in Bermuda when there were a lot of captives there. There's some great resources on the internet. There's a couple.
Are there any trade associations?
There are. So there's definitely captive insurance associations. I would recommend looking at the DCIA, which is the Delaware Captive Insurance Association, because not only does my father sit on the board there, but it's a great local. Delaware is the smallest state, so it's kind of the department there and the association itself are just really lend themselves to being involved in that one-to-one basis. There are other, professional liability underwriting society plus has some stuff on captives, but it's I would like to see like the modern captive, the millennial captive association.
Okay.
Like those people who are kind of looking at things.
Yeah. Let's create a millennial group for captives.
That's it. That's it.
Got
That's
it.
it. Millennials and nerds.
This is the Aaron. This is the part of the podcast where I maybe learn a little bit more about you, and I use it as because I'm lazy. So I'm going to pick your brain and see where you are on a couple things. Two questions I ask all my guests: what tools or techniques do you use to stay productive and/or organized?
I have a great tool. My mother sits 4 feet from me, so
Oh
she makes
boy.
sure that I stay productive. No, I recently got into yeah, sorry, whatever. I recently I'm not a big technology guy. I wish I was more of a technology guy.
But you have that wireless headset. Come on.
Right, I just
You
got this
completely
wireless
fooled.
headset. I feel like
You
it's amazing.
completely fooled me.
It was I joined this Zoom meeting and it didn't ask me to click any buttons because it's already installed on my computer. I felt like I really achieved something today. Two things that I really actually like that I've gotten into recently are going to sound lame because they're intuitive Microsoft apps, but I like the Microsoft to-do list because it just syncs with my phone, so I'm kind of into that. And I recently became a big believer, although I'm trying to figure out how to really implement it at my company on a more productive level in the Microsoft Teams app because it just the way that you can organize things in terms of chat functions, file sharing, and things like that. I use Dropbox, which definitely keeps me efficient. But I try not to have paper, but
You're
that's it.
millennial.
I'm a millennial, but I do like the idea of the apps, and if anyone has suggestions for more efficient ones that sync with my phone and with my tablet, just because randomly in the middle of the night I'll remember something, and unlike my parents who are amazing and don't forget anything and will come in the next day, I was like emailing myself reminders, but it just was not efficient. So
Yeah. You don't just call your mom?
no, my mom calls me. We get people. We send emails. When my parents met my wife for the first time before we were engaged, my father looked at her and said, Michelle, Aaron will never have a vacation, so just know what you're signing up for, which is true, but it's yeah, we work all the time and sometimes none of the time, but we work, because that's why we're here. There's cell
Okay,
phones,
so
so.
so let's test how millennial your office is. So you have your dad on one side, your mom on the other. How many times a day do you does one of you just send an email to the other and not say, "Hey,
Oh, all the
Aaron"?
time, all the time. We switched phone systems like 7 months ago, and it was very hard for my parents to figure out the intercom, especially my dad. And so he just went to the shouting model, and then we converted to the email model. We tried text messaging, we tried WhatsApp, but that was like well above our office capacity. We just got a new printer, which everyone knows how to fill, so that's kind of like a real technological advancement for us. So I feel kind of good about that.
Old school, real
Right,
old school.
real. That's it.
I love it.
And we
I
still have a
love it.
typewriter. So, but apparently it's really valuable. So we still have a typewriter.
Yeah, it's an asset now.
Very hard to find
It's
someone to
vintage.
service it though. We have a typewriter and a grandfather clock, and it's very hard to find people to service them. So
Yeah,
yeah,
what's that TV show on PBS where they look at vintage items and put a price on it?
like vintage auction or something like that. Yeah, I know
Yeah,
what you're talking about.
whatever. Yeah, I bet.
Yeah,
Yeah, type. You don't see a lot of typewriters.
yeah,
That and like rotary phones, they're vintage.
exactly.
Yeah.
Did you see there was that great video of the millennials trying to use the rotary phone to get in like 2 minutes of down the phone number? I said to my parents, like, you did something good bringing me up as even though I'm millennial because I know how to use a rotary phone. Yeah,
Yeah,
like I did
and
something.
I mean, if you've never used a rotary phone, there are shortcuts too. I mean,
Yeah,
0 and 9, you can make 0 and 9 move faster. It's
but
just manual. You have to
crazy
force it,
talk, crazy
you
talk,
have to
crazy talk.
force it to move faster.
Settle
That's what
down
I
now.
did.
People are getting a little wild now.
Aaron, what books have been influential to
So
you?
I'm just gonna pitch this one again. Everyone should read Insuring Tomorrow. I like
Hmm.
Insuring Tomorrow. Obviously, Tony's a great guy. I do like The End of Insurance because this is something that I've been talking about a lot. Someone gave me a book a few years ago called How to Sell When Nobody's Buying by Dave Lackme. I think that's how you pronounce it. Great book just because at the time I was just really getting into sales and getting into advisory, and it kind of turned my view on things because I felt like nobody's ever going to buy insurance. Nobody's going to buy this high net worth personal or this service oriented. Everyone loves the internet, and it was kind of it changed my mindset a little bit. So I like that, and I just bought Powerful Personal Brands by Ben Baker, which I know that's we're in the same social media circles, but I haven't gotten to that yet. But I'm definitely gonna get to that. So
Speaking
those are
of
mine.
social media, how can people find you?
So you can find me on LinkedIn, Aaron Gordon. I'd love to add you to my followers or connections. Also, in the near future, depending upon when this releases, I will be trying to venture more into social media, Twitter, Instagram. We're going to see how that goes, but I am NY Risk Advisor on both Instagram and Twitter, so you can catch me there. You can also email me, aaron@gordoncompanies.com, and our phone number's online. Feel free to call me, and we'll go from that's. I'd love to. Anyone's welcome.
Yep. Well, I'll put all of those in the show notes, and I won't let the cat out of the bag, but I have a feeling our audience will be hearing more from you
I
in,
I hope so.
in the very near future. So we'll just kind of hint at that. The little foreshadowing from Profiles and Risk. That's how we do things here. And thanks for spending a few minutes on a hot afternoon talking about captives. I learned a lot.
Thanks. I really appreciate it, and thanks for making this dream of mine come true.
Ah, don't say that.
That's
You're
it.
you're you're embarrassing me.
It's
No,
the backdrop. It's
thanks
the backdrop. You're not blushing.
thanks for bearing with me on schedule. It took us like months to get this on the
That's the
calendar.
insurance
Our
world.
schedules have been crazy, and hey, let's do this. Since you gave out your social media information, if you're a listener or a watcher and you've gotten this far, by the time this airs, you better send a note to Aaron because he's going to be a dad. So
That's thanks. Fourth time. So thanks.
fourth time, congratulations. I don't know how you do it.
Thanks so much. We try.
So
My wife, great wife, married well.
she's a saint, right?
That's it. Exactly.
Putting up with the no vacation Aaron Gordon. So my guest this week has been Aaron Gordon. We talked captives. Aaron, thanks so much.
Thanks. I'll talk to you.